Assalamualaikum warahmatullahi wabarakatuh to Puan Emma. We are given assignment to do a presentation in chapter 5 for Financial Accounting 2, DPA20033. We are from Commerce Department. We are from class D82A K1. We are from session December 2020. My name is Syadiyah binti Basree. My matric number is 01D82 0F1015. My partner in this presentation is Yungzi 01D82 0F1002 and NURUL ATIQAH binti JAMALUDDin AHMAD 01D82 0F1014. Thank you to Puan Emma for giving us opportunity to present for chapter 5, accounting for trade payable, provision and contingent liabilities asset. So this is the chart about what we are going to present in this presentation. Liabilities. MFRS 101 defines liability as an item of current liability when A. The entity expects to settle the liability in its normal operating cycle. The entity holds the liability primarily for the purpose of trading. C. The liability is due to be settled within 12 months after the reporting period. D. The entity does not have an unconditional right to defer settlement of the liability for at least 12 months after the reporting period. Terms of a liability that could, at the option of the counterparty, result in its settlement by the issue of the equity instrument do not affect its classification. So me, Syadiyah binti Basree, will present about current liability, about trade payable and other current liabilities. For trade payable, the definition and classification of trade payable. Trade payable are cash on by an entity to the supplier of goods and services. It is further defined in MFRS 132 as financial liabilities that give rise to a contractual obligation to pay cash or other assets to the supplier of goods or services that has a contractual right to receive cash. As an example, we as a owner of a business or entity, we must pay a debt to the supplier. For the initial recognition of trade payable, according to MFRS 9, a financial liability is recognized when an entity becomes a party to a contractual provision of the instrument. An entity shall recognize a financial asset or a financial liability in its statement of financial position, and only when the entity becomes a party to the contractual provision of the instrument. MFRS 9311. One of the initial recognition of trade payable is a party to the contractual provision of the instrument. Trade payable are recognized in the financial statement when an entity has become a party to a contractual provision. An entity becomes a party to contractual provision when it acquires goods or services on credit and has an obligation to the supplier to settle the credit in the future. So as we can see, we have here as example 501. Focus IBHD purchased good amounting 10,000 ringgit from its supplier Vision Pro BHD. Focus IBHD is offered terms of credit 2/10 net 30. Focus IBHD agreed to settle the credit on day 15 after the purchase. Is Focus IBHD a party to the contractual provision of trade payable? The answer is Focus IBHD become a party when they agree to purchase and pay cash on day 15. Example 5.2. Refer to example 5.1. Assume Focus IBHD agreed to settle the credit using its investment on day 10 after the purchase. Is Focus IBHD a party to the contractual provision of trade payable? The answer is Focus IBHD become a party to the contractual provision of trade payable when they agree to purchase and pay by other means of financial asset investment on day 10. they agree to pay their trade payable by using investment on day 10. Subsequently, in initial recognition of trade payable, we have purchase discount. Purchase discount is a discount given by the supplier. The most common type of purchase discount are trade discount and cash discount. Trade discount is usually given on the day of purchase to encourage bulk purchases, and cash discount is offered to the customer to encourage prompt settlement. For example, a credit term that is written as 5/10 net 30 offer a 5% discount if payment is made within 10 days and no discount is given if payment is made within 30 days. So as example, in example 5.3, based on example 5.1, let us assume that Focus IBHD has agreed to settle the credit on day 10 after the purchase. Is there a discount given to Focus IBHD when it is the purchase recognized? The answer is the Focus IBHD received a discount of 2% because the bill was paid within the discount period. The purchase is recognized on the purchase date. For initial measurement of trade payable, the measurement of trade payable are historical costs. Measure provide monetary information about asset, liabilities, and related income and expenses using information derived at least in part from the price of the transaction or other event that gave rise to them. In historical cost, if we make account that have a historical cost, we need to put a fixed price even the market price has changed, either the price is increased or decreased. For the current value, measure provide monetary information about asset, liability, and related income and expenses, using information updated to reflect condition at the measurement date. So as you can see at down here, the measurement of the transaction price can be recorded as below. Debit purchases account, credit trade payables account. When the payment is made, we debit the trade payable account and credit the cash account. So it was how we do the account with debit and credit. In example 5.4, Focus IBHD purchased a good amounting to 10,000 ringgit from its supplier Vision Pro BHD. Focus IBHD is offered terms of credit of 2/10 net 30 and they agree to settle the credit on day 15 after the purchase. What is the amount of trade payable? Prepare the journal entry to record the credit purchase. So the answer is we debit purchase 10,000 ringgit and we credit trade payable 10,000 ringgit. This is a recording the credit purchase. Example 5.5. Based on example 5.4, let us assume Focus IBHD agree with the credit term and settle the amount within 10 days. What is the amount of trade payable? Prepare the journal entry to record the credit purchase and payment. So the answer is the amount of trade payable is 10,000 ringgit. So for the recording the credit purchase, we have the answer in the example 5.42. So we go to the recording the payment. So we in recording the payment is we debit trade payable 10,000 ringgit, credit cash 9,800, and we credit discount received 200. 200 is we get from 2% of 10,000 ringgit. Presentation of trade payable. Trade payable should be present as a current liability in the statement of financial position. So statement of financial position as at 31 December 2018. So as you can see, under the current liability, trade and other payable in the note of 19. So as you can see in the soft P, trade payable is under current liability. So this is trade payable as balance as at 1 January 2018 and balance as at 31 December 2018. So trade payable are non-interest bearing and the normal credit terms granted to the group by the supplier that range between 30 and 90 days from date of invoice. Include in the deposit received of the group are tenant deposit received from franchises amounting to RM 2521000. Other current liabilities. So other current liabilities such as accrued expenses, advance from customer, dividend payable and tax payable. Definition and classification of other current liability. Other current liability are not financial liability because there are no contractual liability to be settled. The settlement of other current liability in the future, if any, will only result in an outflow of resources such as cash. Example 5.6. Focus IBHD owe its employee RM2000 for wages at the end of an accounting period. Has Focus IBHD becomes a party to the contractual provision? So the answer is no. Unpaid wages are not financial liability. Therefore, Focus IBHD is not a party to the contractual provision. The company will only make an adjusting entry to accrue the expense at the end of the accounting period. Initial recognition of other current liability. Other current liability are to be recognized in the financial statement when it is probable that an outflow of resource embodying economic benefit will result from the settlement of a present obligation. B. The amount of the settlement can be measured reliably. Example 5.7. Focus IBHD pay its salesperson a 5% commission on sale. Focus IBHD current year's sales is RM 6,000 ringgit, but until year end, its payment on sale commission is only 20,000 ringgit. Determine whether it is probable that an outflow of resources embodying economic benefit will result the settlement of the present obligation and the amount can be measured reliably. Is unpaid commission a current liability? The answer is yes. The settlement of the obligation in the next accounting period will result in an outflow of resources such as cash. The 10,000 ringgit unpaid commission can be measured reliably. Yes, unpaid commission is a current liability because A. The entity expects to settle the liability in its normal operating cycle. B. The entity holds the liability primarily for the purpose of trading. C. The liability is due to be settled within 12 months after the reporting period. D. The entity does not have an unconditional right to defer settlement of the liability for at least 12 months after the reporting period. Terms of a liability that could, at the option of counterparty, result in its settlement by the issue of the equity instruments do not affect its classification. Initial measurement of other current liability. The initial measurement of other current liability is also at historical cost, same as in the initial measurement of trade payable that we see in previously. So at historical cost, liability are recorded at the amount of proceeds received in exchange for the obligation, or in circumstance, for example, income tax, at the amount of cash and cash equivalent expected to be paid to satisfy the liability in the normal course of business. Other current liability are also liability, and therefore the same basis for measurement is used. The initial measurement of other current liability is this item and adjusting entries. Accrued expenses, wages, salaries, commission, interest and utilities. In the adjusting entries is we debit expenses and credit accrued expenses. For the item advance from customer, we debit the cash and credit prepaid revenue. For item dividend payable, in the adjusting entry is we debit the dividend expense and credit dividend payable. In the tax payable, we debit tax expense and credit tax payable. Example 5.8. Refer to example 5.7. The initial measurement for unpaid commission would be debit commission expense 30,000, credit cash 20,000, credit accrued commission 10,000. So this is the same as a trade payable, the representation of other current liability. So other current liability can be present in the statement of financial position. So it is under the current liability, as you can see, trade and other payable in the note of 90. So as you can see, balance as at 1 January 2018 and balance as at 31 December 2018. Other payable is under trade payable. So as you can see, other payable, we have third party deposit receipt and accrual.
Assalamualaikum warahmatullahi wabarakatuh. My name is NURUL ATIQAH binti JAMALUDDIN AHMAD. My matric number is 01DAT20F1014, and I'm gonna explain about non-current liabilities, which is bonds and other non-current liabilities. Bonds, definition and classification. According to MFRS 132, a financial instrument, bonds, defined as any contract that gives rise to a financial asset of one entity and a financial liability or equity instruments of another entity. A bond is also defined as a derivative financial instrument in MFRS 132. A derivative financial instrument or other contracts within the scope of this standard has the following characteristics. First, its value changes in response to the change in a specified interest rate, financial instrument price, commodity price, foreign exchange rate, index of prices or rates, credit ratings or credit index, or other variable, provided in the case of a non-financial variables that the variable is not specified to a party to the contract. B. It requires no initial net investment or an initial net investment that is smaller than would be required for other types of contracts that would be expected to have similar response to change in market factors. A bond becomes a financial liability because there is a contractual obligation to deliver cash or other financial assets such as investment. To investor, it is a financial asset. MFRS 132 has defined a financial asset as any asset that is A. Cash, B. An equity instrument of another entity, C. A contractual right to receive cash or another financial asset from another entity, to exchange financial asset or financial liabilities with another entity under conditions that are potentially favorable to the entity, and D. A contract that will or may be settled in the entity's own equity instrument. Initial recognition of bonds. Bonds are to be recognized as non-current liabilities in the statement of financial position because they are due to be settled more than 12 months after the reporting period. In MFRS 132, it is further classified as a derivative financial instrument, which is financial liability, because there is a contractual obligation to be settled within a specified time period, and the amount to be settled is based on the market price. According to MFRS 132, an entity shall recognize a financial asset or a financial liability in its statement of financial position when and only when the entity becomes a party to the contractual provisions of the instrument. As a consequence of the principle, an entity recognizes all of its contractual rights and obligations under derivative in its statement of financial position as assets and liabilities. This is based on MFRS 132. Example 5.9. On 1 January, Focus I Berhad purchases a bond 10% at market rate, 10 years, 10,000 ringgit for 10,050 ringgit and paid a brokerage fee of 50 ringgit to invest Berhad. Is the bond a financial liability and a derivative financial instrument? And the answer is yes, it is a financial liability because Focus I Berhad has to settle the obligation within the specified time period to invest Berhad. It is also a derivative financial instrument because the price follows the market price of bonds. Initial measurement of bonds. Bond is measured at its transaction price. The transaction price is the fair value of the consideration given or received. A financial instrument is regarded as quote in an active market if quoted prices are readily and regularly available from an exchange, dealer, broker, industry group, pricing service, or regulatory agency, and those prices represent actual and regularly occurring market transactions on an arm's length basis. The fair value must be agreed by the issuer and investors in the most profitable market for both parties. Here, we look at the measurement of bonds at par, premium, and discount. The first one, at par. Coupon rate is equal to effective market rate. If we want to record proceed from the issuance bond, you have to debit the cash account and credit the bond account. But if you want to recognize interest expenses on bonds every year, you have to debit the bond interest expenses account and credit the cash account. Now, we look at discount, which is the coupon rate is less than efficient market rate. The first one, to record proceed from the issuance of bond, you need to debit the cash account and debit the discount on bond account. And then you have to credit the bond account. But if you want to recognize interest expenses on bonds every year, you need to debit the bond interest and expenses account, and you need to credit the discount on bond account, amortization, and credit the cash account. And last but not least, which is at premium, the coupon rate is more than effective market rate. And to record proceed from the issuance of bonds, you need to debit the cash account and credit the premium on bond accounts and also the bond account. If you want to recognize or amortize interest expenses on bonds every year, you need to debit the bond interest expenses account and also premium on bond account amortization, and you need to credit the cash account. Example 5.10. Focus I Berhad issued a 10% 10,000 ringgit par value bond. The bond matures in 5 years. The market rate is 10%. A. What is the total proceed received by Focus I Berhad? And B. What is the journal entry? For A, book value equals to invest plus redemption sum. When you want to calculate the invest, you need to times the present value interest factor of annuity with 1,000. Where do you get the 1,000? 10 over 100 times 10,000. You will get the 1,000. And you want to calculate the redemption sum is present value interest factor times with 10,000. And then you will get 3.7908 times 1,000 plus 0.6209 times 10,000. And last we will get 9,999 ringgit and 80 cents. Rounded adjustment is to 10,000. B. To record proceed from the issuance of bonds. As you can see here, from what I have explained earlier, you have to debit the cash account 10,000 and credit the bond account 10,000. For another one, to recognize interest expenses on bonds every year, you need to debit the bond interest expenses account 1,000 and you have to credit the cash account 1,000. Example 5.11. Focus AHMAD issued a 12% 10,000 ringgit par value bond. The bond matures in 5 years. The market rate is 10%. A. What is the total proceeds received by Focus AHMAD? And B. What is the journal entry? A. Book value equals to invest plus redemption sum. So, to calculate the invest, the present value interest factor of annuity times with 1,200. Where did you get the 1,200? 12 over 100 times 10,000. You get it. And then for redemption sum, the present value interest factor times with 10,000 ringgit. And then you get 3.7908 times 1,200 plus 0.6209 times with 10,000 ringgit. And then you get 10,757 ringgit and 96 cents. If you see the answer for A, you will notice that the total proceed is more than effective market rate. So to record the journal entry, you need to use the premium one. For B, to record proceed from the issued bonds, you need to debit the cash account, which is 10,757 ringgit and 96 cents, and credit the premium on bond account, which is 757 ringgit and 96 cents, and credit the bond account, which is 10,000. To recognize or amortize interest expenses on bonds every year, you need to debit the bond interest expenses account 1,200, and you need to debit also the premium on bond account amortization 757 ringgit and 96 cents over 5 years, and you will get 151.592, and then you need to credit the cash account, which is 1,351.592. Presentation of bonds. As explained earlier, bonds should be recognized as financial liabilities in the statement of financial position as illustrated below. As you can see, under the non-current liabilities, there are financial liabilities, which is debt instrument. This is bond. This is an illustration for the financial liabilities debt instrument. They are at cost for more than 3 years and at fair value for more than 3 years. Other than bonds, a company may also seek other types of borrowings such as bank loans, notes payable, redeemable preference, shares, and etc. Definition. Non-current liabilities are liabilities that are incurred for the purpose of trading and are expected to be settled in the future. Initial recognition and measurement of other non-current liabilities. Non-current liabilities will be recognized in the statement of financial position when it meets the definition as provided in the conceptual framework and as stated in MFRS 132. As discussed, the initial measurement of other non-current liabilities can be measured on the base of historical cost and current value. This is a presentation of other non-current liabilities in the statement of financial position. As you can see, under the non-current liabilities, there are other liabilities. This is the other non-current liabilities. And here is the note for other liabilities, which is at cost for more than 3 years and at fair value for more than 3 years. Now, I will explain a little bit about provision, and my friends Ng Yuzi will talk mainly about provision, contingent liabilities, and contingent assets. Provisions. Definition of provision. Provisions are liabilities of uncertain timing or amount or both, based on MFRS 137.10. A provision can be classified as a liability because it has all the characteristics of a liability, which are A. a past obligating event has occurred. B. The entity has a present obligation. And C. There is a future outflow of benefits. However, there is a need to differentiate provisions from other liabilities such as payables and accruals due to uncertainty about the timing or amount of the settlement. Let us compare provisions with payables. Payables are liabilities to pay for assets, goods or services which have been agreed with the supplier. Therefore, the timing and amount of payment to be made are certain. On the other hand, the timing or amount or both for the payment for provision are uncertain. Examples of provisions include provisions for litigation, warranties or product guarantees, and refunds. The seller has an obligation to honor the warranty and refund the customers. Provisions. Example 5.12. Explain how each of the following items can be reported in the statement of financial position. A. Accrued rent expenses. Description in the statement of financial position is accruals under current liabilities. This is because the timing and amount of liability are certain. Second, account payables. Payables under current liabilities if payment due within 12 months, or non-current liabilities if the payment due is beyond 12 months. This is because the timing and amount of liability are certain. The third one, which is loan from bank, it is in the non-current liabilities. This is because the timing and amount of liability are certain. The fourth one, lawsuits in which the outflow of resources is not probable. It is not a liability. This is because there is no present obligation as the outflow of resources is not probable. The fifth one, lawsuits in which the outflow of resources is probable. It is a liability and shown under current liabilities or non-current liabilities. This is because there is a present obligation as the outflow of resources is probable. Next, warranty to customers. It is a liability and shown under current liabilities. This is because there is a present obligation as the outflow of resources is probable. The seventh one, contractual bonus to employees, which is a liability and it is shown under current liabilities. This is because there is a present obligation as the outflow of resources is probable. And the last one, future operating loss, which is not a liability. This is because there is no present obligation as the loss is not yet incurred.
Thank you, ATIQAH. I'm Angyusi and my matrix number is 01DAT20F1002. I'm going to present about the provisions, contingent liabilities, and contingent assets. First, let us look at the initial recognition of provisions. A provision is only recognized when it fulfills these three criteria. First, an entity has a present obligation, whether legal or constructive obligation, as a result of a past event. Second, it is probable that an outflow of resources embodying economic benefits will be required to settle the obligation, and a reliable estimate can be made of the amount of the obligation. Next, I will explain about the definition of some terms in these three criteria. First, what is past event? Past event is an obligation must have occurred in the past to create an obligation at the reporting date. For example, a sales of tables in the furniture company which was already happened in the past. Next, the present obligation is divided into two forms. First is legal obligation and second is constructive obligation. The legal obligation may arise from a contract, whether in the form of explicit or implicit legislation or obligation of law. Obviously, the legal obligation is enforced by law. Here is an example of present obligation. The focused eyebrow provides warranties to accompany the sale of its eyeglass frames to its customers. Based on industry experience, it is estimated that the entity would incur 140,000 ringgit warranty costs in 2019. Thus, focused eyebrow have a present obligation and can be the amount for provision be estimated reliably. The answer for this example is yes, the focused eyebrow has a present obligation, which is an agreement in the warranty of its eyeglass frames arising from past event. The past event in this case is the sales of glass frames to the customers. So the second criteria in the recognition of provisions is it is a probable future outflow of resources. So in this case, when it is happen when to rectify defects in the products, to exchange the defective frame with a new frame, or to make a full refund to its customers. Lastly, the third criteria in the recognition of provisions is the amount of obligation can be estimated reliably. So in this case, yes, the amount of provision for warranty can be estimated reliably, which is 140,000 ringgit from outsourcing contract based on the company's past industry experience. Then the constructive obligation may arise from an entity's actions where, based on an established pattern of past practice, published policies, or a sufficiently specific current statement, the entity has indicated to other parties that it will accept certain responsibilities, and as a result, the entity has created a valid expectation on the part of those other parties that it will discharge those responsibilities. So the obligations are communicated to others through explicit communication, such as published policies or specific current statements. Other than that, the obligations are also communicated to others implicitly through actions. For example, the established patterns of past practices. Next, the probable future outflow is the event is more likely than not to occur. In other words, the probability that the event will occur is greater than the probability that it will not occur. The last term in the recognitions of provisions is reliable amount estimations. Since the nature of a provision is uncertain in terms of timing or amount of both, an entity has to estimate the obligation amount reliably, for example, based on its past industry experiences. Here is an example of constructive obligation. The focused eyebrow has a policy of refunding purchases to its dissatisfied customers. Even though the entity has no legal obligation to do so, the policy of making refunds is made known to the public. Thus, focused eyebrow have a constructive obligation, and can the amount be estimated reliably? So the answer is yes. The focused eyebrow has a constructive obligation, which is shown by the policy has created valid expectation that dissatisfied customers will be refunded as a result from past event. The past event in this case is the sales of its product to the customers. Next, future outflow of resources is probable because it is probable that some of the goods sold will be refunded by the dissatisfied customers. Lastly, the focused eyebrow is able to estimate the obligation amount reliably. So in conclusion, a provision is recognized in the financial statements of focused eyebrow in the reporting date. Measurement of provisions. The amount recognized as a provision shall be the best estimate of the expenditure. So what is the best estimate of the expenditure? It is the amount that an entity would rationally pay to settle the present obligation at the end of the reporting period. An entity also needs to make a reliable estimate of the obligation amount. Then an entity has to estimate the provision based on its previous experience of similar transactions and reports from independent experts. If a provision involves a large population of items, the obligation amount is estimated using expected value approach to determine the probability weighted outcomes. Before looking at the expected value approach, let us look at the 5 factors that may affect the amount of provision to be recognized. First, best estimate. The amount recognized as a provision must be the best estimate of the expenditure required to settle the present obligation at the end of the reporting period. Second, risks and uncertainties. The risks and uncertainties that inevitably surround many events and circumstances shall be taken into account in reaching the best estimate of a provision. Third, present value, where the effect of the time value of money is material. The amount of a provision shall be the present value of the expenditures expected to be required to settle the obligation. 4. Future events. Future events that may affect the amount required to settle an obligation shall be reflected in the amount of a provision where there is sufficient objective evidence that they will occur. The last one is expected disposal of assets. The gains from the expected disposal of assets is not considered in estimating the amount of a provision. Here is an example of expected value approach. Focus Iberhard uses this approach to estimate its provision for repairs. The following table shows the probability weighted estimate for repairs provision based on past experiences and future expectations. There is 3 types of frames, which is the past experiences and future expectations show that 70% of goods sold will have no defects, and 20% of goods sold will have minor defects, and 10% of goods sold will have major defects. So if minor defects were detected in all products sold, repair costs would be 100,000 ringgit. Whereas if major defects were detected in all products sold, repair costs would be 500,000 ringgit. And by using the expected value approach, Focus Iberhard recognizes a provision for repairs of 70,000 ringgit, which is the sum of the goods sold of minor defects and major defects. So the journal entries to record the provisions will be as follows. The debit side is a debit repair expense, credit provision for repairs. The amount is 70,000 for both. The presentation of provisions in the financial statements. We will look at the statement of profit or loss and statement of financial position. So in this example, the statement of profit or loss for the year ended 31st December 2019, or we call statement of comprehensive income, which is SOCI. So in this example, the provisions is written as the other expenses, which is amount 670,000 ringgit. And before we look at the statement of financial position, we have to know the difference between current liabilities and non-current liabilities. Current liabilities is expected to be settled during the 12 months from the reporting date, whereas non-current liabilities is expected to be settled more than 12 months from the reporting date. So in this example, statement of financial position as at 31st December 2019, the non-current liabilities is provision for education, 600,000 ringgit, which will be settled more than 12 months from the reporting date. And the current liabilities is provision for repairs, 70,000 ringgit, and will be settled within 12 months. I had explained about the recognition, measurement, and presentation of the provisions. Now let us look at the contingent liabilities. A contingent liability is a possible obligation that arises from past events and whose existence will be confirmed only by the occurrence or non-occurrence of one or more uncertain future events not wholly within the control of the entity, or a present obligation that arises from past events but it is not recognized because it is not probable that an outflow of resources embodying economic benefits will be required to settle the obligation, or the amount of the obligation cannot be measured with sufficient reliability. So we will know the contingent liability is totally different with the provisions. In conclude, a contingent liability is different from a liability because it is uncertainty. Next, I will explain about the terms in the definition of a contingent liability. Possible obligation is the obligation cannot be classified as a liability because the definition of a liability is not met if the outflow of resources is not probable or an amount cannot be measured reliably, whereas the amount of liability can be measured reliably. The differences between the present obligation, which I had discussed in the initial recognition of provisions, and the possible obligation. First, the present obligation have a probable future outflow, but the possible obligation have no probable future outflow. Next, the amount of present obligation is reliably measured, while the amount of possible obligation is not reliably measured. Then, the present obligation is defined as a provision and recognized as a liability in the financial statements, while the possible obligation is defined as a contingent liability and disclosed in notes. The recognition of contingent liabilities. We should not recognize a contingent liability unless the possibility of an outflow of resources embodying economic benefits is removed. An entity should disclose a contingent liabilities at the reporting date. A brief description of the nature of contingent liabilities needs to be provided and where practicable. First, an estimate of its financial effect, an indication of uncertainties relating to the amount or timing of any outflow, and the possibility of reimbursement. Now we will look at how the disclosure of contingent liabilities in the notes, because the contingent liabilities and assets are not recognized in the consolidated statement of financial position of the group. Here is an example of contingent liability which is disclosed in a note. Note 26, contingent liabilities. The company has given corporate guarantee to a bank for bank guarantee, and banking facilities extended to a subsidiary. None of the bank's banking facilities were utilized as at the reporting date, and the outstanding bank guarantee as at the reporting date is 693,750 in 2013, while the amount is 883,750 in 2012. The value of financial guarantees provided by the company to its subsidiary is determined by reference to the difference in the interest rate by comparing the actual rate charged by the bank. If their guarantees have not been available, the directors have assessed the fair value of their financial guarantees to have no material financial impact on the results and the retained profits of the company. The definition of a contingent asset according to MFRS 137.10. Similar with the contingent liabilities, a contingent asset is a possible asset that arises from past events and whose existence will be confirmed only by the occurrence or non-occurrence by one or more uncertain future events not wholly within the control of an entity. Next, the recognition of contingent assets. Same with the contingent liabilities. An entity should not recognize a contingent asset. A contingent asset should be disclosed in the director's report where an inflow of economic benefits is probable. The disclosure includes the nature of the contingent asset and, where practicable, the estimated financial effects of the assets. The example of contingent assets include a claim that an entity is pursuing through legal processes where the outcome is uncertain, and possible refunds from the government in tax disputes. When the realization of income is certain or virtually certain, then it is recognized as an asset and not as a contingent asset. Last, we will look at the example of contingent asset. The Focus Eye Berhad is taking legal action against Borneo Optic Berhad for failing to deliver on contracts for its products. The lawsuit is in the final appeal. The legal advice is that it is probable that they will win the case and will be awarded 600,000 ringgit. It is possible for Focus Eye Berhad to recognize this item as an asset. The answer is no. It cannot be recognized as an asset, and this is disclosed as a contingent asset because the asset is only be recognized when the gain is certain or virtually certain. Here's the end of our presentation. Thank you for lending your precious time.